now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. Today we're back with expert trader Chris Vermeulen of the Technical Traders. How you doing today?
I'm good, Daryl. How are you?
Doing good, doing good. Markets are going crazy and everything. So just wanted to touch base with you. People are panicking, people are selling, people are piling in the gold. There's talk of recession. There's so many things going on. Tariffs, it's so many things going on. And so
Yeah.
let's start at a high level. So we have these issues with the tariffs where there's been multiple different messages that have been given being sent to the investors, the markets, and then when they come out, oftentimes they're changed or they're increased. So we have this happening with China and the U.S. right now. How are you seeing that impacting the markets on your side from the trader's perspective?
Yeah, well, it's like any trader investor right now feels like we're walking through a landmine. You don't know what tweet or what comment or what new rule or regulation is going to be like paused, delay, implemented, canceled. So there's no doubt it's added volatility to obviously the markets and risk to anybody involved in the markets. The thing is, it doesn't just affect the stock market. I mean, we're seeing bond prices move, we're seeing currencies move, interest rates swing. It's, this is rattling everyone's cages pretty much. Any type of investor, if you own anything, and even business owners. I've been talking to a lot of subscribers, and a lot of people have, and I used to do this as well. As I used to run an importing business. I had my own health product lineup that I used to sell across Canada, United States, and it was all from China. And these new tariffs, doubling, more than doubling the cost of goods to come across is really hurting the businesses. And not only that is it's going to make it expensive for people to buy stuff in North America or the United States because of the tariffs. So I think inflation, I feel like the whole tariff stuff is somewhat of a power play. There's a bigger underlying game being played. I think most of it will probably be retracted, and it's really just I think it's just a bunch of noise, some underlying games being played until I think some chips fall into the right places. This is going to continue on. So I'd like to think these tariffs aren't here to stay. It's all just talk and rumor and short term. And yeah, it's
Yeah, yeah.
yeah.
Yes, it seems like there's some negotiation tactics here and being used and everything, but ultimately it's impacting, people's lives, people's portfolios. I mean, if you're expecting to retire and let's say you are in a 401k and your 401k has a little bit more risk to it, then you may have to delay that retirement, and then when we get to like the inflationary aspect, that's gonna impact the everyday people that buy these goods. So JP Morgan has come out and talked about recession. Jamie Dimon has been very, very vocal about it. There's been multiple people that have been vocal about it. This has been in the conversation for the last 5 years, I would say, about whether we're going to have a recession or not. Do you have any take there?
Yeah, I mean, I've been talking about this for a long time. I think you and I even touched on this a while ago on our last talk here, which I believe the market's running out of steam. All the signs are here that the bigger things, to me, a lot of macro data, economic data is slowing. It's showing signs that there's a transition coming. The money's been flowing through various assets in different sectors, telling us that there's huge fear. Gold spiking is one of the most powerful kind of global barometers that this isn't just like North America fear. This is like the whole world is getting ready for some type of huge reset. And this is what we saw just before the 2008 financial reset. And now we know banks can go bankrupt literally overnight. We know the housing market can implode. I mean, there's a lot of different reasons for the housing market imploded, but people are nervous. And I believe we're going into a recession. I kind of feel like we're already in one. I think in Canada, where I'm at, where it's like unemployment's already like 7.5%. I think things are about to get really ugly, and the stock charts, typically asset prices move first, and then the economic data follows. Investors are savvy, they're smart. We can look into the future and say things don't look good. Looks like inflation's here to stay. Prices are going up. Sales are starting to slow. And so investors are like, well, I got to start trimming back. These stocks aren't going to perform very well. And so the stock market and assets sell off in fear. And then the data actually comes later saying, oh, yeah, earnings are down on most companies and things like that. So follow the price, and the news typically follows, or the macroeconomics kind of follow.
Gotcha, gotcha. Well, yeah, let's get into some charts. Can we start with the VIX?
Yeah, let's take a look at the VIX here.
Yeah, I saw it spiked. I was gonna play a put option on it when it was really high, and then I missed that opportunity. But then now it's kind of bounced back up.
Yeah, I mean the VIX is definitely showing some big fear. If we zoom way back in time, this is just going to go way back to all the way to let's actually go right back to 2008. So we can see that the VIX is up at a level that if I was to draw a horizontal line, we saw it spike really this week, to a level, and it's trading kind of at a level. We've seen lots of big spikes in the past. Um, The VIX is difficult to trade because it's kind of like you're trying to pick up pennies in front of a steamroller. Like a lot of times the VIX just fades lower. There's no real return, but the one time that it does work, you get this huge spike. It's very difficult to trade the VIX. I think silver, I think natural gas, they all kind of have this similar type of play. It can be very difficult, but fear is high. And the fact that, we've seen the VIX start to pull back a little bit to me doesn't mean a whole lot. The VIX can stay elevated and trade sideways, and it can even slowly fade down a little bit while the stock market keeps crashing. In fact, sometimes the biggest spikes in the VIX actually aren't anywhere near the market lows. Um, and is there's just it's just the way people perceive the markets. Like we had a really weak close last Friday, and I was telling everybody, I'm like, okay, we closed at the lows on Friday. That means Monday is going to be a huge gap down. Everybody's going to freak out, and then we're going to see a huge spike. And that's exactly what we saw take place. And I believe the markets, are still going to go lower, and the VIX is going to be elevated for a while. There's a lot of fear, but short term wise, I do think this market is trying to find a little bit of attraction to put in a bounce when as they say, the VIX is high. It's time to buy. Um, I don't like to go by that because if the VIX is high, that means the market is in a downtrend, and I don't like to buy anything in a downtrend. I'd rather let it bottom versus trying to pick a bottom. So the VIX is really good at throwing people off to try to pick a bottom, and there's a delay, and usually it leads to bottom pickers getting hurt and having bad positions. But there's definitely fear in the market, and the type of fear that we had over the last few sessions. I mean, it was big. It really turned people around. If we look at the SP 500, this was the really interesting thing. If we look at the SPY ETF, for example, obviously we got this huge drop, but it's interesting because everybody through here was trying to pick a market bottom, and all through here they're trying to pick a market bottom, and then even over here, and more or less just even this bar, we have data that shows when people are trying to pick a bottom. And everybody says, I'm picking the bottom, I'm picking the bottom. And I'm telling everyone, don't try to do it. It's going to hurt. And then what happens is we have a very weak close on a Friday, which is this bar. And then this was the Monday. This Monday's open. It opened sharply lower, flushed down in the morning, massive volume. And everybody who's trying to pick a bottom finally hit a breaking point where they had to get out and take the loss. And this was also a tipping point where people who just held on to their long positions also hit a fear level where they say, that's it, I'm done, I'm out. And they exit their longs, and then the market rebounds right after it. The market is perfectly designed for people without a real proven strategy, emotional traders trying to pick tops and bottoms to absolutely screw them over. And Monday was exactly that. And then this huge 12% rally on the QQQ a couple of days ago is just enough to like rub the salt in the wounds, give people FOMO, really piss people off. This is what the market does.
Yeah.
And we avoid all this because we can identify when the trend changes. We actually saw the trend change right up here on the 26th of February. We exited the market because everything was telling us get out. And then the market's just gone into this, it's a nightmare scenario for most people. And there really isn't
Since
much of a safe haven play. Like even bonds have sold down, and yeah, it's a
yeah,
difficult play.
yeah, that's pretty interesting. So when we look at this, so one of the I don't know if that huge candle was when Trump had tweeted out that,
Yep.
oh, there's going to be a 90-day pause on the tariffs, and then we saw a huge bounce.
Mhm.
And so how do we factor that into the equation? Because it's like, that was just a tweet. Like you could have I mean, the fear was extreme at that point, and then you get this huge rebound. I
Yeah.
mean, it didn't bounce back to the old highs. Like even, my long-term portfolio, I think it bounced 5% in one day, but it's been like on a 7% like decline over the last month. But how do we factor in some of those types of things?
Yeah, well, I just drew on the chart here. So there's first of all, it's a news-driven move, and all at this point, this is just robots and a bunch of people chasing the news, trying to trade the news, driving things up. He's delaying, just like he's done in the past. There was a rumor about it, I think, the day before, and I think Trump even said on his like Truth, whatever his platform is, he said something like, "This is a buying opportunity," and of course, I think obviously he knew what was coming down the pike. And of course, he says that the day before, then the market rallies. He's probably trying to, he's very smart. I mean, I think they are playing a game that people listen to every word he says now. He said it's a buying opportunity, and then the markets rallied 12% the next day, which there's a ton of options traded just before the news and the spike that huge money was made. There's a lot going on. But if you just get rid of all of that conspiracy and all that BS stuff and try not to get caught up in it, because anything where there's money involved, there's always manipulation. And it's always been there. It always will be. So I know some people get hung up on all this and how people are making money. But if you look at it from a pure technical standpoint, first of all, it's a news-driven move, so I don't give it much power. I don't care if it's a 20% rally in one day. In fact, the bigger the move, the more of a BS move it is, in my opinion, just because it's news-driven and it's an emotional herd, everybody trading on that. So whatever happens on news, usually the market gives it back within a few trading sessions. Um, so that's the first thing. Don't trust the news-driven move. The second, it rallied right up to this breakdown level. So it hit resistance on the chart. And that's a natural spot for it to happen. The other is if we use a Fibonacci retracement level. So I took the high all the way down to this low, and it tells us these levels, a 38% retracement, a 50% retracement. This is naturally between 50 and 38. This is the natural spot that if something was going to have a huge move down, then it's going to come and settle somewhere into this range, and then it can continue to go lower. And so it's come right up to that 50% level as well. And so all of that is pointing to, hey, okay, it slammed into resistance, and now on news, and now it's getting rejected. And now the market needs to figure out what it's going to do. This market is noisy, it's unpredictable. There's a reason we got out right over here, because everything was saying things were about to go haywire. This is just like what happened just before COVID. We literally got out a couple bars from the top just before COVID, not really even knowing it was going to happen. And then suddenly all hell breaks loose and we go into this type of price action. So you need to have strategies to identify this, and you really want to avoid it. Unfortunately, most people see this 12% move yesterday in the QQQ. And I mean, I read comments and I get emails from people, and it's so emotional. People are saying, okay, that was the bottom. Everything has changed. This was a big enough move that we're starting a new bull market. I'm like, are you nuts? Like this, at this point, this is just a bear market rally. We've actually started a bear market as of really last week. And things have broken down. And the biggest rallies, the biggest one day pops almost always happen in a bear market. They are normal. And if you think you can catch them, and you should catch them, you've got serious problems, because it means you're always trying to pick a bottom. And these moves happen in a knee-jerk reaction. And a lot of times you can't see them coming. So you really have to step back and understand, okay, the bull market now is over at this point. We're in a bearish environment. Uh, Everything is so volatile, it's not worth putting your money at risk. Let's wait for this to shake itself out, create a new trend and pattern that has some predictability, and then let's take advantage of it. And the big question, Daryl, really comes down to, if I was to just zoom out on the chart a bit here, I mean, we've broken some very significant pivot lows on the chart. We've broken this low, we've broken this low, and this low. These are significant standout lows that investors look at, and that is why we have such a huge flush and a massive spike in volume, because these are saying, okay, the trend has clearly reversed to the downside. And now the big question is, how is this market going to rebound? Is it going to rebound up and put in some type of, eventually stall out and kind of take its sweet time to roll over and continue to go down? I believe we're going to see a very big correction. I think the last time you and I talked, I think I even mentioned, I believe we're going to break the 2023 lows and potentially even lower than that. Or is this market going to just go into a series of big red bars and we go into like some huge, 1929 style crash? It just keeps bleeding out. No one knows. That's the reality of it. And you have to have a strategy saying, hey, if this market wants to move up and maybe keep rallying, our strategy will get us back in. If the market has this bounce and then it has a nice controlled rollover and we get a sell signal, we can take advantage of falling prices through moving to a different asset class, trading an inverse ETF. But right now is not the time to be messing with this market unless you really know what you're doing. And you really have to ignore the noise. You have to follow the longer term trend, which is down. You need to identify the shorter term trends and make sure they're in line with each other. So it's not about trying to catch a bounce and rally here. It's more so letting it bounce and rally. And then when it stalls out and starts to go down, that is when you want to look for inverse ETFs or move to a different asset that will rise as stocks fall. But everybody wants to try and catch a bounce, and that's the dangerous part. Everybody tried to catch the bounce through here and here and here, and then they pretty much got hurt and panicked out of all their positions, their longs and their short bottom picking trades right when just before it reversed.
Yeah, definitely. Thanks for sharing that. That's very insightful. Could we look at gold, and then also could we look at oil? Oil's been getting decimated.
Yeah. So gold's on fire. There is so much uncertainty, and I think I think these tariffs are going to make things very expensive in America. And simply everything's going up 20 to 100%. Almost everything you flip over is made in China. It's got the biggest tariffs. So prices of things are going to go up, and businesses are going to struggle. Sales are going to come down. I think this is forcing us into a recession. And of course, when there is this much uncertainty, gold finds the sweet spot. Gold did have a pretty sharp pullback here. And this was right when the stock market had that huge wave of panic selling. And this is what people need to be aware of. So right now, gold is still in a bull market. It is still strong. It's in a phase where it can continue to push higher. My next upside target is 3,275, which is very close to hitting now. And then we'll be able to reanalyze the next move. But the selling that we saw in gold, this is what happens when we hit a full recession and a stage 4 bear market, which I think is coming over the next couple of months. When the stock market has consistent selling and the VIX is elevated and it's just never ending pressure, we will see it happen in gold. We'll most likely see gold pull back and have a very big correction in price and wipe out a bunch of the gains right now. But at this point, gold is the clear leader. That there's all kinds of chaos, there's uncertainty, and gold continues to be that favored play. Same with gold miners. Gold miners have been doing very well. If we look at gold miners, they're pushing up and hitting some big highs, and they're having a big gap and a big exhaustion type of move. I think maybe that we're going to see a little bit of a pause or pullback in the precious metal space for a minute, for a couple bars or so. But I'm still bullish on gold. I do think longer term, though, I think later this year we'll be able to pick it up at a lower price. It'll build a launch pad for it to go a whole lot higher in 2026 and beyond. But right now it is the crowded trade. Everybody seems to be piling into it. And, that's what everybody wants to own at the moment.
Okay. Yeah. That's good. Could we look at silver real quick and then go over to oil?
Sure. Silver's having a nice move today, up 4%. It's finally making a little bit of a comeback. Silver is very speculative. It's great during a new bull market phase. It can perform exceptionally well, but it naturally kind of stair steps its way higher, and then it always takes the elevator down. This is a pretty sharp drop. I mean, if we look at the drop just in the last few sessions, 22%. That's not something I like to really mess with. That's why I like gold. It's much more stable. A huge pullback in gold is like 5-7%. And it requires a bloodbath in the stock market for gold to pull back. And that's what happened. But silver takes it on the chin. It has rebounded really just into resistance. If we draw a line across here, there's pivot highs, there's pivot lows. We have a cluster of moving averages, the 150-day, the 50-day, 20-day. So it is running into resistance. It's definitely nowhere near all-time highs, nowhere even near the highs from just a few weeks ago. So silver's making a comeback, but to me, it has broken to the downside. It's had an impulse move down. So when it has a strong move to the downside and it breaks multiple standout pivot lows, which it has broken a series of them, once you've broken through enough support levels, it obviously has some pretty strong momentum. I always look at these pivot lows as like floors in an apartment building. If you break through one floor and then stop on the next one, you did a little bit of damage. You didn't have a ton of momentum. But when you bust through 5 floors, you know that is there a lot of selling. It's a heavy thing. It's got a lot of momentum to it to the downside. And so it's busted through a bunch of floors, and now it's just kind of having that reaction bounce. It's oversold. It moved too far, too fast. And now investors are kind of gobbling it up, saying, oh, it's undervalued. And they pile in, and you get this kind of what I believe is kind of a dead cat bounce. Now, maybe silver wants to go back up, test these highs and go up. But overall, it is a more volatile, more difficult way to make money in this particular environment. When we have a full recession and a bear market and it comes to an end, silver and miners will be the preferred play, and we throw gold in the back seat because it's too slow. But when we're in a major market top, gold is the play. It's slow, it's more consistent, it naturally wants to push to new all-time highs versus to deal with all this noise and waste a bunch of time and stress in it.
Got it. Got it. Okay. Yeah. Thanks for sharing that. And then as before we wrap up, could we look at oil?
Yeah. So oil's had a pretty darn big breakdown. We zoom way back on the charts here. This is a significant pivot low. You and I touched on this the last time we talked, that if it breaks clearly below the the 65 level, that is going to wreak havoc on the markets. It's usually I was saying there's probably going to be some economic data, something that breaks it and triggers that we've got bad news that a recession is coming. To me, it seems like tariffs were the play. And I think tariffs have really kind of are capping the growth for the US markets. And so we've seen a big breakdown, and now it's trying to figure out what to do. So our downside target for oil, and we've talked about this many times, the downside target for oil was 55 to 56. And using Fibonacci extension, we came down and we hit that. So we had the power of the sell-off, the rebound level, and then typically we come to the 618 and have a hiccup. We go down to the 100% level. This is the 618 and the 100% level. We hit that this week, and now it's rebounding. And so now the big question is, it's probably going to maybe go a little bit higher and find some resistance along the 65 area, or maybe it's just going to trade sideways and stall out before it starts another leg down. But my overall downside target for oil is going to be about 45 or so. Could even be lower than that, but it's now hit our 56 target. Now we have to let it work itself out, and then we can analyze the next leg down using this high, this low, and wherever this bounce goes to, and that'll tell us where that next leg is. It's the same scenario for gold. We take each scenario, and then we remap where that next leg is going to push. And that's kind of how I follow it. And now that oil's broken down, it's doing a lot of damage to energy stocks. Energy stocks have broken down below support as well, and now they're struggling in a very big way.
Sore topic for some folks watching this video, I'm sure. So yeah, my energy stocks are like just decimated.
Yeah, and this is like one of the big things. Like this is you and I touched on this also. We've got this huge move up in energy stocks. More so, they've put in a topping phase in the last several months. While energy stocks have been going up, at the same time frame we were looking at oil has been going down. So there's this huge divergence where why are energy stocks going up if they're making less money, and the economy is coming to an end? And if oil breaks down, it is going to break the backs of the energy stocks. And now we're finally seeing that play. So oil is broken down, energy stocks are breaking down, and I think a really good play is going to eventually be if energy stocks are going to stabilize. They're going to build a bear flag here, or potentially a little bit of a bounce up here. Eventually, they're going to start to roll over, and there's going to be another massive leg down. I see XLE being down in the low 60s. There's huge potential, but right now it's already had the break, and now we need to see the pause and bounce for that next leg. And energy stocks are going to play catch up, and energy stocks are dividend payers. And dividend stocks have been beat up really hard, and people don't realize how dangerous dividend stocks are. But the problem with dividend stocks is the majority of the money in the stock market are people who are like 50 years or older. They're the ones with all the money. They've worked their entire lives and they all own the same stocks. They're all told through their advisors to buy dividend stocks. They're big, they're solid, they're not going anywhere, but there is a huge disconnect between a company and its share price. You can have the strongest company and the share price goes to nothing. You can have the weakest company and the stock price goes ballistic. And dividend stocks, I mean, poor, investors are down like 20% or 16% on what are supposed to be the most stable and strongest stocks. They're down the same, actually more than the SP 500 in the kind of a similar time frame. So you don't get a whole lot of benefit out of these because the same people are all dumping the same shares at the same time, which is why dividend stocks have these huge falls during the stock market crashing. And in fact, dividend stocks fall more than the SP 500 during financial crashes. And advisors will never tell their clients that. They sell them on buy it for the dividends, make your 4 or 5%. In these strong companies and you'll be good, but they don't tell them you're going to lose more than the stock market in many cases. So, and a great reason I bring this up is because it's tied into energy stocks. A lot of big energy stocks are about to get crushed. Their earnings are going to come down, which means dividend stocks are going to get sold. As we go through this, I saw as 2008, 2009, energy stocks start cutting their dividends. When they cut their dividends, the share price falls. When they cut the dividends, the energy stocks get kicked out of specific ETFs that are focused on dividends. Certain fund managers will remove stocks if they're not paying dividends anymore or their dividends are going down. So holding dividend stocks through a bear market phase is almost suicidal. It's a terrible, terrible play. Yet the whole world does it. And because everybody does it, they think it's the right thing to do. But the reality is it's the wrong thing to do, even though everybody does it. So
Yep.
that's my take on it.
That's true. That's true. Well, thank you, Chris, for jumping on and giving us those takes and that analysis from the technical charts. And so everyone, be sure to go over to the technicaltraders.com to check out Chris's services and some of the work he's doing. I will also link to his YouTube channel where he puts out more updates for you all to be able to connect on a regular basis. And so, Chris, thank you for joining us today and look forward to having you back.
Yeah, appreciate it. Anytime. Take care, everybody.